Hello, everyone. Today on the final bar, stocks plunge, technology, the FANG stocks moving to the downside. The Nasdaq Composite down over 2% today. Danielle, Shay of Simpler Trading is going to help us unpack what we saw, look at a particular group she sees as being fairly actionable. Finally, we talk about Tesla and Netflix, the two names pushing lower. What may be the next shoe to drop? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the power of the StockCharts platform. Our platform was designed almost 25 years ago by Chip Anderson, a former Microsoft engineer, really trying to empower individual investors, online investors, to make better decisions. And really, the technical analysis toolkit was created a long time ago to empower investors to better understand what was happening by focusing on price action. Just with a lot of the conversations I've had recently with investors trying to struggle through this period, trying to talk about overvaluations versus trend following. How do you deal with stocks that have already had an incredible run with the potential for that run to continue? And at the end of the day, I always remind them that, think less about what should happen or what could happen. Focus on what is happening. Focus on gathering evidence. Focus on looking for signs of rotations and sign for improvement or deterioration in some of the key charts that you're looking at. Today, we're finding a very different character to the market than we have in quite some time. We're seeing quite a bit of a distribution. The Nasdaq Composite down over 2%. Is this just the beginning? Let's look at the charts here together in our market recap. See what happened and how today's move may fit into some of the bigger picture themes that we've been talking about. Before we get to the market recap, by the way, I do want to start with a poll question. We're often asking polls on our social media platforms, on our YouTube channel. Of course, just make sure you subscribe and you won't miss the next one. We asked you, which regional ETF do you think performs best over the next 3 months? And in this case, we're talking about regions as in global regions. You have three choices: US, non-US developed or global developed, or global emerging markets, SPY, EFA, or EEM. Over half of you said US over anything else. Just 9% saying developed markets, which would be developed Europe and Asia, and 34% of you saying EEM. What's really interesting about this answer, I'm actually surprised we didn't get more of an interest in global developed, because charts like Japan are actually remarkably strong right now. When you think about non-US markets and where there have been some strength recently, it's a lot of times less in emerging markets and more in some of the developed markets. We've talked at times earlier in 2023 about strength in the UK and France and other sort of developed European markets. Now, Japan, as we talked yesterday with Dana Lyons, talked about that move higher in Japan, EWJ, but especially the DXJ, which is a currency-adjusted Japan ETF. Over half saying in the U.S., and I would say probably I would agree with that. The strength in the U.S., particularly the dominance of the technology sort of growth trade. That is one of the big differentiators of when you think about U.S. versus non-U.S. markets. It's usually the big concentration in technology. Now, here's the problem. If we have a big 3-month pullback and all this big growth strength, and this is the beginning of that move, that question, the answer is going to be not the U.S., but I get it, and I would agree with the masses here. SPY would probably get my vote as well. Let's continue on with the market recap. Let's look at what happened today. As I mentioned, a big distribution day for the Nasdaq for sure. What's interesting is with the Nasdaq down over 2% into the close, the Dow actually up by 0.5%. Now, how does that happen? How do you get that big spread between the two? It all comes down to what sectors and what types of names are represented in those different benchmarks, right? So the Nasdaq Composite, obviously very growth-oriented, the S&P arguably as well, but the Nasdaq especially so. So the FANG sectors of tech, communication services, consumer discretionary, those sectors are weak, which they are today. The Nasdaq Composite is going to be leading the way lower, and that is what we're seeing. The S&P finishing lower by about 0.7%, closing around 45.35. So not an end-of-the-world kind of day, but certainly a distribution day. The Dow actually finishing 0.5% higher, and if you look at the sectors that did well today, utilities, healthcare, energy, these are the type of sectors that are going to be a little more Dow types of names, although not a lot of utility stocks in the Dow, but those sorts of names, sort of the traditional, economy types of names are much more heavily weighted. Had a much better go of things today. Mid caps and small caps down as well. The S&P 600 small cap index down 0.8%, actually underperforming the S&P 500, but the Nasdaq, of course, the weakest of the bunch. Nasdaq 100, by the way, which is more of the sort of mega cap trade within those FANG sectors, down the most, down 2.3%. The VIX back up to a 14 handle, just narrowly above 14. That's up a little bit from the 13 and change where we've been at for quite some time. Again, up relative to the last week or so, still relatively low compared to the last 12, 18 months where volatility has been fairly elevated. 2023 has more and more been a slow and steady incline in prices on lower volatility, which is more sort of a classic bull market progression. I would argue one of the most defensive things, one of the most negative things you could see for stocks is a spike in volatility, because people don't kind of panic and then start buying, right? Panic is when you sort of emotionally and suddenly sell to try to get out of the way of things. And so that's why volatility tends to spike when the market's going down, or as the market maximum would say, the markets go up the elevator and down, or excuse me, up the escalator, down the elevator. Let's look at the fixed income markets, check in on what happened here. Interest rates, for the most part, moving higher. The short end of the curve pretty stable from yesterday, but 5, 10, and 30-year points all moving to the upside. The 10-year yield finished today around 3.85, and the 5-year yield back above 4% to 4.1. 30-year yield at 3.9. So, we've talked about how rates have not really pushed to the upside. You've actually seen bonds and stocks moving up together. Today, the opposite. You're seeing bonds and stocks all moving lower for the most part, and interest rates pushing back to the upside. Dollar index moving a bit higher as well, and that's a little different. We've had a weaker dollar, and that's what's allowed some of these risk assets to move higher. Stronger dollar certainly changes the dynamic of that trade. Gold and silver both down. The GLD was down 0.5% today. Silver price is down 1.8%. For the most part, the rest of these, we're seeing a lot of green on the charts, particularly in the energy space. Energy was one of those groups that actually did just fine today, while technology, again, those FANG sectors were moving lower. Finally, cryptocurrencies continues to be a pretty volatile space. Bitcoin is really revolving around that 30,000 level. That's a key kind of anchor point, or maybe what we might call a pivot point. And for me, when I use a phrase like pivot point, for me, it's more about a level that has meaning. It's a level we tend to revolve around. We tend to overshoot and undershoot. It's kind of an equilibrium point. It's a point at which buyers and sellers are kind of in agreement. And what's happening with Bitcoin is we're sort of going above 30,000 and back below 30,000, kind of fluctuating back and forth around that sort of pivot point or equilibrium level. Continuing through today, Bitcoin down just slightly, 0.6% lower to around 29,740, and Ethereum prices back below 1,900. Looking at the 11 S&P sectors here, very defensive feel to the top of the list, with utilities winning the day, up 1.8%. Healthcare up 1.7%. If we have time, we'll look at charts like Johnson & Johnson having a decent update today. Energy stocks up 1.2% for the XLE, then consumer staples number 4. The 3 FANG sectors are at the bottom, and if you wonder why the Nasdaq is down and the Dow is up, just look at this and look at the the sectors at the bottom and the amount that they're going down. Now, the issue with these sector ETFs, or one of the issues, I guess, is they are very top-heavy, meaning they are heavily weighted to the biggest stocks. So, within technology, Microsoft, Apple make up about 50% of the XLK. In consumer discretionary, it's Amazon, Tesla, Home Depot. Those are about 50% of the ETF. So the XLY leading the way lower, down 3.4% today. Tech and communication services both down about 2% as well. Let's go to a chart of the S&P 500, just kind of check in on where things are at. Then I'm going to show you a sentiment indicator I think you should be aware of. The S&P dropping today, of course, coming off of a new high. So I feel like the headline for most shows recently has been the S&P makes a new high for 2023, and here's where it is. A little something different today. This drop pulls the S&P out of the overbought region. Looking at the daily RSI here at the bottom, so the classic sort of measure of momentum that we like to refer to. What's so interesting is we had this bearish divergence in mid-June to late June. Higher prices on lower momentum sort of alleviated as the market made another new high on stronger momentum. Today, coming out of that overbought region, which basically suggests at least you're probably in some sort of pullback And the question is it a brief, just couple points kind of pullback like you saw in early July, or something more significant? And that's where, it's all about recognizing some sort of trailing stop, recognizing at what point, what's your line in the sand where you would admit that something is getting a little more dangerous. The weakness that I'm seeing on charts tells me that downside move from here much more likely than I would have said yesterday, because you're starting to see the catalyst sort of potentially play out here. As I would remind you, with most of the charts we'll look at that have been making new highs, is there's a lot of room below current levels that we can make a higher low, a couple hundred points below current levels, and still look like a pretty decent medium-term, long-term uptrend. And I think that's the reality of the strength that we've seen of the trend in the first 6-7 months of the year, is that you've got plenty of downside and still be within a pretty consistent uptrend. Now, I mentioned a sentiment indicator to pay attention to. We don't talk a lot about the AAII survey. I used to focus a lot more on it, but kind of got away from it. The reason why I wanted to show it to you today was just to indicate that bulls are over 50%. And just to orient you very quickly to the chart here, I just want to update this annotation here. We have the S&P on a weekly basis in the top panel. The next panel down is looking at the percent of bullish respondents and the percent of bearish respondents, bulls in green, bears in red. And we have this histogram designed this way because every week you see, are people bullish, bearish, or neutral? That's basically the question that you're asked. And I think the language is for the next 6 months for stocks. And the level of bullishness right now is around 51% as of today's reports. That's votes over the last week. If you look to the left, this pink dotted line is just to show you where we're at relative to where we've been. It's pretty rare that you have the bullish reading this high, and that's why I think it's kind of interesting. I don't see sentiment indicators like this as a great timing tool, which is why I'm not saying it's above 50%, so pound the table, we need to sell or anything like that. I don't think it's that clear cut, and I don't think the relationship is as direct as you may want it to be. As a matter of fact, in extended bull markets, a lot of times you can get these indicators to become bullish and then remain fairly elevated for quite some time as the market continues to process an extended uptrend. What's so interesting, though, is this market, according to this indicator, has been sort of in a disbelief phase of sorts, right? The market has been going higher, but the level of bullishness has not been particularly strong. Now, all of a sudden, we're getting to some of the highest readings we can. And to me, what that would tell me is that there's been a lot of skepticism, and now all of a sudden there's been a big bullish rotation. What I'm concerned about is that the last sort of gas, right? Is that finally the masses coming in and recognizing, okay, now we're in a bull market. It would be perfectly ironic and actually a very classic development if that ends up being right about the top when you finally get extreme bullishness. The spread between bulls and bears, currently around 30%, is also one of the highest ratings we've seen in quite some time. If you look to the left, only a couple times in the last 5 years you've had readings this high. Both of those happened in sort of the 2020 to 2021 bull market phase. So I wouldn't consider this a fantastic timing tool. For me, when I see excessive optimism as a contrarian, my contrarian hat, I put that on and I think, all right, I'm looking for some signs of rotation. And that's why today's distribution feels like it may be at a perfect time based on the contrarian bullish signals we've seen there. Let's continue on looking at a couple of sectors. I mentioned utilities having a nice update. Now, the challenge with the chart of utilities is if you look at the absolute price movements, it's kind of a yawner, right? If you look at the last 2 years, utilities really haven't gone anywhere. This is a low volatility, kind of stable, kind of sluggish sector. And what I often think about, utilities can actually lead in a bull market phase. That has happened, but it's much more common for utilities to do well in a bear market phase. And the reason is because the real benefit is it's low volatility. So if the market's going down, it tends to go down a lot less. It's lower beta, meaning you have a lot less risk involved if you're buying a utility, and the high dividend component. Now, a 3% dividend yield is a lot less awesome when your CD is getting 4 to 5% in a regular savings account, but it's still a decent place to be if you have to have equity exposure and you're just looking for places to ride out a period of uncertainty. So a nice bounce higher. The XLU is back above the 200-day moving average. I think the absolute prices are going to be less interesting to me than the relative strength. You're just seeing this bounce here. I would look to see if utilities on a relative basis can continue to go higher. Now, healthcare, kind of a different story. And if you look at the XLV, you can see a trend line from the December peak down to the April peak comes in right about there. And that's where we've just broken out over the last week or so. The XLV was up about 1.7% today, but that's the latest update within this move to the upside. The momentum getting stronger with the RSI now above 60. The relative strength still pretty early on. It's been in a downtrend for quite some time because the growth stocks have been working and healthcare has not, but I'm starting to see some signs of real improvement there. Just looking at some individual names on the move. We talked about yesterday charts like Netflix, coming out. Big drop today with the updated subscriber numbers down 8.4%. It was interesting after market yesterday as we were reporting on the show. Not a huge move, but I think as the earnings call went on, as investors digested all of the realities of what they read and what they heard, really getting a vote of no confidence today, down about 8%. Again, I think the chart of Netflix tells you the issue with a lot of these growth stocks, not really the issue, but the reality is when you've had such a consistent uptrend, even a big down day still is making a higher low, right? We're not kind of undercutting recent swing lows just yet. So I think, again, the danger is, or I guess the reality is you need to see, I would argue, a little more of a follow through to indicate more of a pullback. This may be the beginning of something more, but even an 8% drop is still making a higher low relative to this longer-term trend that we've been observing. We're going to talk about semiconductors with my guest today, Danielle Shay. So I don't want to talk too much about it, but I would tell you that charts like Applied Materials are interesting to me. What's interesting about it now, down 5.5%, is it's sort of at that point of no return. When you've had a stock that's had a really good run, look at this bearish divergence, by the way, mid-June to late June, weaker momentum. Now you're seeing the stock drop again as it failed to get above 145. So you have a failure to make a new high. Now you have a pullback to an ascending 50-day moving average, the RSI right around 40. This is the point where it's either a really good buy on the dips kind of chart, which means we bounce off the 50-day and you feel like a rock star genius for buying in on the most recent higher low, or things deteriorate further. That's why I think it's a key chart to watch, not just today, but tomorrow over into next week to see if that ascending 50-day moving average may hold or not. Just to finish off here, I want to highlight, can we finish a market recap on a high note? I feel like that's been tough to do sometimes because we've been talking about, stocks that have been moving lower recently. But if you look at the chart of AbbVie, we've talked so many times about the bearish divergences with higher prices and lower momentum. Here's the opposite. AbbVie actually featuring what we call a bullish momentum divergence. They can happen. We just haven't had a lot of stocks in downtrends, so it hasn't been a really interesting time to highlight that kind of thing. But if you look at the lows here, so pretty stable lows, but on a closing basis, we kind of slope down from late May to late June. Look at the momentum, oversold on the low in May, not oversold, so higher lows as we have lower lows in price. That's a bullish momentum divergence, so a nice follow through to the upside. What's interesting is sectors like healthcare, like financials, even in some cases like energy. These are the areas of the market that have been struggling. We're starting to see more of a bullish rotation there. That, I think, is an equally important theme, not just some of the potential weakness in the growth space in the markets. I want to bring on today's guest, Danielle Shay. Before we do it, a couple quick announcements. First off, we would love to hear from you, particularly your questions for our Final Bar mailbag. Best way to get your questions to us via email, thefinalbar@stockcharts.com. On Twitter, just tag us in a comment at FinalBarSCTV. If you're on the YouTubes, just put a comment below the video you're watching. I'd love to hear from you and hope to answer your question in our next mailbag segment. Also, as a reminder, we have a big-time summer special happening at StockCharts. Go to stockcharts.com/special for all the information. This is a really good sort of flash summer sale for our premium account levels. This is where you really can make the StockCharts platform sing and help increase your understanding of the markets. Things like custom indicators and custom chart designs using all of our indicators that we have available. The ACP platform, which has some very powerful dynamic indicators and price analysis tools, and our scan engine, which is one of my favorite ways to really understand where the opportunities may be. If you're an existing member, you can extend your membership at the current low level. So check it out at stockcharts.com/special. I want to bring on today's guest, Danielle Shay. Danielle's the VP of Options at Simpler Trading, coming to us from Austin, Texas. Danielle, it's a pleasure to see you again. How are you?
I'm doing great. How are you? It's great to be back.
It's good to see you. I'm glad you're back on the show. At some point, we'll get you here in the studio again because last time we had a really good time talking with you here, but it's a pleasure to talk to you remotely today. We have obviously a lot of places we could go, but a lot of newsworthy moments, I feel like, in the last week or so. Particularly today, we have growth areas of the market pulling back. We're starting with your chart of the Qs. How do you make sense of a day like today? What does it mean in terms of your perspective?
So when you're looking at the Qs, I mean, we've just had this phenomenal run moving up into earnings. We've had a lot of momentum behind that. And as you pointed out, a lot of bullish sentiment. You know, a lot of the times when everyone is bullish and we're on the flip side of that coin, when you start getting some negative news, it can reverse and pull back really quickly. And so that's what we're seeing right here. You know, we had this triple whammy with Tesla, with Netflix, and with Taiwan Semiconductors. Then you also have the Nasdaq rebalancing. So when you're looking at the chart of the QQQs, what I always like to do when we start this pullback is I like to look at this for pullback zones where I can, you know, hedge, get some bearish trades on, see if I can trade that index back into the 8 EMA and then the 21 EMA and then the 34 EMA as that momentum pulls back. So you know, when you're looking at the Qs today, we already really pulled back into the 375 price point. So, you know, your next zone is really going to be around 372 or so. I don't know if we're going to make it because we're holding 375 really well, but if we do flush through that 375, then that next level to look for is going to be 372 and then 370.
It's such a great chart, and I love this sort of ribbon kind of feature with all the different moving averages. You can really see the strength in the trend, and it makes a day like today really jump off as sort of a, you know, potentially a counter trend move to the run we've had. Let's talk about some of the names that are on the move today. Tesla, of course, one of the challenging names, moving down quite a bit around earnings. What's your sense of Tesla after this drop here?
So when you're looking at Tesla, you know, I think it's a pretty disappointing move, number one, because I mean, they had record profits. They've had just incredible delivery numbers. And when you look at their EPS estimates versus their beat, I mean, they did really well. So you have a situation where you have a company that, you know, for the most part, their report was incredibly strong, and yet it's getting hit. Now, initially, when it first pulled back this morning, it was within an expected range. In the options market, they were pricing in about a $20 move. And so this morning it was down about 17. And I thought, you know, it's not really that big of a deal because whenever you see a move within the expected range, it's just typical, right? Well, then what happened was as it continued to fall throughout the session, you know, you end up down the day. Let's see, you're down what, 28 points. And you've broken through the 21 EMA. That's really where you get to a point where you say, okay, you know, now it's a little bit deeper of a pullback. It's bigger than expected moves. This is really going to continue to weigh on the Qs, which is why it makes it a better idea to look at a bigger pullback in the Qs. When I'm looking at Tesla right here, I mean, you can see that it is holding at a critical support zone right around 260 to 262. So that's kind of my last line in the sand. It's a Fibonacci symmetry pullback zone. And if it can't hold on to that level, we're probably going to be looking at 250. So I think with Tesla, you know, you do have that opportunity for it to hold and bounce into tomorrow, but it's really just going to depend if we get an overnight gap down or not.
Microsoft is another name. I think they're reporting next week. Been in the news a lot with the Activision Blizzard acquisition. Overall, down a bit, down about 2.3% today. Overall, what's the take here technically?
So, you know, the big take here with Microsoft is one of my favorite tech names as well. But what can happen with Netflix and Tesla is when they come out and they pull the market down, then we start to see that reverberating through the rest of the Nasdaq and the stocks that are going to be reporting next week and the week after. So, you know, you have Microsoft pulling back here as well. And, you know, Microsoft is one that I typically make bullish trades on surrounding earnings. But when it was up at that new all-time high, I mean, that's really hard to do, right? Because it was pretty extended. So ideally, what I'm looking for here is, you know, Microsoft can pull back along with Netflix, Tesla, and the Qs. And then as we get into Tuesday, I'm going to look and see if I can have some bullish trading opportunity going into that earnings report and then post earnings in Microsoft, because Microsoft does historically trade higher post earnings.
You mentioned a little bit, and I know the last time you were on the show, Danielle, we talked a lot about just the strategies around earnings. Can you just talk a little bit more? Microsoft is one of those names coming up next week. This week, I feel like people are getting shocked and surprised to the downside with names like Tesla and Netflix setting up pretty well, but then just getting crushed. How do you trade around something like Microsoft? Is there a particular strategy that you go into it? Is it more about that particular stock and what it does around earnings, or how do you approach it?
So it's really a three-pronged approach. I mean, number one, I want to look at the stock and say, okay, am I going to make a bullish call on this, a bearish call, or do I think it's going to be neutral? But that also depends on where the stock is trading right before the report. Because, for example, I'm bullish on Tesla, I'm bullish on Netflix, I'm bullish on Microsoft. But what can happen is if the stock is, right up at those highs, and the report is good, you can still see it pull back because the report was already priced in. So that will determine that third piece of my approach, which is how am I going to actually trade it? So with Microsoft, definitely bullish. When we're looking at where it's going into the report, right now it's at a pretty good point because we pulled back to the 8 EMA. When you're at the 8 EMA, certainly you can try to make some bullish trades. It's a little bit more ideal if you can get a deeper pullback into the 21 EMA. It's also not very common for Microsoft to pull back that far. So if it does pull back into the 21 EMA, which is going to be around 340, that would be a good place to sell some put credit spreads. You could also do a neutral trade. I like to do a lot of neutral iron condors for volatility crush. And then, that would be a setup that I would use over earnings. Those are usually get in the day before the report, get out the next day. Then there's a third trade that I like to do where I will trade the post earnings move. So let's say that Microsoft does the same thing as Netflix and Tesla, is I would look for, okay, where do I have support? Is this something that I can come in and now that it's fallen, 8, 10%, is there a place where I can buy it? So that's another approach that I'll use.
Oh, it was well said. Thanks for talking through that whole timeline for us, Danielle. I appreciate it. Let's talk about semiconductors. Semiconductors, obviously one of those bellwether groups that have done so well. I mentioned in the market recap, Applied Materials. We're looking at TSM, another name gapping down today. Getting really down into some of those EMAs we talk about. Is there an opportunity here? What do you think?
So when you're looking at Taiwan Semi, I really wanted to see it hold up above $100 a share, just because this is, key psychological value, and it was doing pretty well earlier today. It looked like it was going to hold, and then it ended up breaking down below the 50 simple. I really need stocks to stay up above their 50 simple. I mean, it's just such a critical line in the sand. And right now, it's just below it. So at this point, I think that it's not looking great for Taiwan Semi. I do own the stock, and I do think, in the long term, this is a great play, but they noted multiple different things throughout their report that were a little bit problematic, especially, noting the decreased demand that has been occurring post-pandemic. And the problem with this is it's weighing on AMD, it's weighing on LRCX, it's weighing on the entire semi space. And so when you have, the first companies that come out start weighing on the market, it just creates a contagion.
It's so interesting. I feel like this big rally in 2023 has been fueled by those expectations and the need, that additional demand, the insatiable demand for chips. All of a sudden, we're getting a very different narrative today, and you can see how quickly it's reversing things. AMD is the last name in that same group, down over 5% today. Similar take there?
Yeah. So when you look at AMD, I mean, I really want to just point out, the kind of impacts that reports can have earlier in the season on, additional companies. Because when you look at AMD, I mean, AMD has a very nice bullish trend. It's a company that statistically will trade higher going into earnings. But this one has broken down below the 50 simple. And that's really one of those key lines in the sand where I say, you know what? If you break that zone, especially with a big flush like this, down more than 5%, that's a moment in time where you really have to be cautious and say, okay, is this a part of a bigger reversal? And so, I like the stock. I own the stock. I'm not going to sell my stock. But as far as looking at this, I mean, it is a giant red flag that is a waving right now. And if we can't see buyers come in to Tesla and Netflix and AMD tomorrow and have that be a buy the dip day, then what's going to happen is this is just going to bleed into next week, and we'll probably see a deeper pullback in the Nasdaq.
That's such a great example, and it's funny. I mean, AMD is one that's not reporting earnings for a couple more weeks now, but you see it moving down sort of in concert with other semis. It feels like TSM is sort of affecting everything. Just to wrap up here, so obviously the story of the markets has been strength driven by growth. A day like today, I feel like we're finally getting a bit of a question mark on that thesis. I'd love to know, Danielle, just with the minute we have left, what would you see in the market? Is it further deterioration in the Qs? Is it a particular level that you would see the benchmarks break that would tell you this is a real retrenchment where you need to get defensive and not just sort of lighten up? What would tell you that things are really getting ugly?
Sure. So when you're looking at the Qs, I mean, right now, you've only pulled back past the 8 EMA, 21 EMA, 34 EMA, those are pretty decent pullbacks. So, I mean, that would just be down to 365 in the Qs. If we broke through 357, that would be the point where I would say, okay, this is a major reversal. And I know you might say, well, that's quite a ways lower. Are you serious? 357? Well, that's what we're looking at because the market's been so strong. We haven't seen a real pullback. Any pullback back to the 34 EMA or the 50 simple, it's just a normal pullback within the context of an uptrend.
Well said, Danielle. This was fun. I wish we could keep going with a lot of other examples. This was brilliantly described. Stay safe, be well there, best to your family, and we'll talk to you again soon, all right?
Thank you. You too.
That's Danielle Shay. Danielle's the VP of Options at Simpler Trading, coming to us from Austin, Texas. There are a lot of just great takes on there. I love that way of thinking of moving averages as sort of these different tiers, right? A pullback to level X, one of these early like the 8 or 21 bar EMA, sort of a lighter pullback, but getting through the 50-day simple moving average, this is something a little maybe more different. And recognizing, she used the phrase line in the sand, which I will 100% endorse. I love that way of thinking of it. Also a great discussion about that the markets, right? The stock market does not price in what a company is actually doing, whether or not they're making money. It's all about expectations. That's why more than anything, the market is arguably down today. Folks, we got to wrap up the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. We talked about sentiment in our market recap, talked about the AAII survey. As a reminder, that's the American Association of Individual Investors. It's a commonly referred to data source because it's a weekly survey of mostly individual investors. Investors that have been, in many cases retired or investing a portfolio and just their overall take. The fact that we're seeing this much bullishness after so many weeks and honestly months of skepticism, right? A lack of bullishness as the market has been going higher. Now all of a sudden you're sort of getting this move. The fact that we're getting this high reading on a day when the market is pulling back certainly has a capitulative feel, for lack of a better word, just describing this excess bullishness at a time when we're starting to see some potential topping signals. I would agree with Danielle Shay that there would need to see a little bit more, but I think going to chart number 2, where we are seeing is we're seeing those initial pullbacks. Amazon continuing to show a bearish momentum divergence. If you look at the highs over the last 6 weeks, kind of gently sloping higher. That's that accumulation phase we like to describe it. Look at how the momentum has gone lower. Now, not all stocks have done this. The S&P has actually made another move into the overbought condition, but Amazon actually remaining with this bearish momentum divergence. So on a day like today, I'm seeing another pullback from a new high, but the momentum has gotten weaker and weaker. And overall, that is a big red flag in my own process, thinking when the market's going higher, but less momentum, that implies that there's less demand pushing those prices higher. Underneath the hood, things are not as good as they may seem at the top level. I'm concerned about the drop we see today. I would look to see if we hold support levels. The 50-day moving average right around 124 for Amazon. Still another 6 points below current levels, but getting closer by the day based on what we saw today. Finally, flip the chart of Amazon over and you have what's called a bullish momentum divergence. I want to point out that there are some of them out there, not many, and only because you need to have a pretty good downtrend before you can get a bullish divergence. That's where prices go lower, but the momentum actually slopes higher. It's interesting to me that in a lot of growth stocks, charts like Amazon, you're getting that bearish divergence. Charts like AbbVie, you're getting a bullish divergence. AbbVie today, following through, up about 3.3% today. So is this part of a rotation into healthcare, a sector that has been, underperforming? Charts like Johnson & Johnson, Johnny John, having a decent day and pushing to the upside as well. This is one of those times when the leading stocks, the growth stocks start to struggle. I like looking for names that have been underperforming to see if we get a bullish rotation. AbbVie might be one of those great examples in the biotech space. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the Final Bar. We've had so many great conversations with fantastic experts like Danielle, Shay, and others, all on our YouTube channel. Go back and check out our previous interviews. Special thanks to Danielle Shay of Simpler Trading in Austin, Texas. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.